Welcome, morning. Thank you for coming. This is going to be fun for me, for sure. So my day-to-day job is head of risk and insurance. At the moment, I'm working for a large mining company, and for the work that I do during the day in 2021, Firma named me the risk manager of the year, and RIMS awarded us our case study as the best international ERM implementation, which I thought was extremely ironic because I've been unofficially banned from speaking at Firma and RIMS for years, because I've been a pretty outspoken critic of most of the things that they do. And I thought the double irony was that I was awarded the best ERM implementation, given that I hate everything that ERM stands for. And I think it's the opposite of good risk management. So I thought that was kind of double irony. But I beyond kind of my job, on the weekends and after hours, I have a hobby. It's called Risk Academy, and Risk Academy at the moment is one of the biggest blogs on risk management and non-financial companies in the world, the biggest YouTube channel on non-financial risk management in the world. Couple of chatbots, artificial intelligence that can do monte-carlo probably better than most risk managers. And every October, I run a Risk Awareness Week, which is like a virtual conference. And this year is going to be the 6th year running. And every year we have between 3,000 and 5,000 people participating. So it's probably one of the biggest risk conferences in non-financial services in the world. And I always have to say caveat, because risk management in financial services is a completely different beast to what I do. So today, I needed to kind of to set the context for everything I'm going to show in the next few minutes. And by the way, I bet this workshop is going to be the only workshop where we'll actually use Excel and do proper risk analysis instead of slides, no slides. And few things to keep in context. I'm going to talk about kind of specific things, which doesn't mean if I don't talk about something that it doesn't exist. Like, for example, people usually criticize me that I'm all about quantitative, which is absolutely not true, because I'm also about risk psychology, risk perception, cognitive biases, neuroeconomics, behavioral economics. It's a whole separate field of study. It's not part of my conversation today. But if you ever want to talk about how cognitive biases affect decision making and why most risk analysis techniques are flawed and shouldn't be used because of the effect of subjectivity and how that influences the output, that's a whole separate story. So just because I don't say something doesn't mean I don't do it in my day-to-day work or I don't think it's important. So today I chose to speak about certain things. There's much more to risk management than what I'm going to show today. The second thing that I wanted to set up front is the other critique that I always hear, and I hear a lot because if you connected with me on LinkedIn, I do a lot of communication on LinkedIn, and I think in a year my posts get about 6 million views. So there's a lot of interaction happening, and so the other critique that I hear all the time, it's Alex's way or no way, which again I think is quite misleading because there's really no Alex's way. All I'm doing is bringing something from decision science, probability theory, neuroscience into risk management. So I'm literally opening textbooks on different sciences, and I'm kind of bringing it into risk management. And there's nothing. I wish I could say I've created more, but in reality, I just have a lot of friends. I'm friends with Doug Hubbard, Sam Savage, and a lot of other amazing people that kind of write books, and then I just convert them into practical things and I use them in my work. And then the final thing, which I found just extremely ironic, sometimes people think that what I talk about is theoretical, which I think is the greatest irony of all, because I'm literally showing the models that I used yesterday in work. at actual office doing jobs. And most of the templates and downloadables available on the Risk Academy website are cleansed versions of the checklists and the models and the templates I literally use every day in my work. So basically, whatever I'm usually saying, it's A, based on some sort of published scientific research, and B, I've actually tried it many times. And one of the reasons why we got the RIMS award and I was named the best risk manager in Europe in 21 was because we ended up saving $13 million on insurance by proving to the underwriters that we can quantify risks better than they can. Sometimes it worked, sometimes it didn't work, but on different policies over the band of a year, we ended up saving $13 million, which was about 40% of our insurance budget, while doubling and tripling the limits and not changing the deductibles, right? Because raising deductible, reducing the limit, it doesn't take a lot of brains to save on insurance. Try saving on insurance by tripling your limit, not touching the deductible, and still saving a lot of money. That was a very nice end-of-year board presentation. When to the shareholder, I was explaining that we just paid for the whole department for the next 10 years, and risk management actually makes a lot of money. So that's the context of what I wanted to talk about. But the first thing, and I'm going to ask a lot of kind of open-ended questions to help you hopefully realize the significance of what I'm saying, because some of the things are going to be the very opposite of everything you ever knew about risk management. And I want to kind of slowly bring you to the realization, and hopefully you'll come to the same realization. I came 15 years ago, and I've never been back to the RM1 world. I'm very proud that I haven't done a heat map in 10 years. Despite various attempts of external auditors and internal auditors and even some shareholders asking me about it. So it's possible. It's not a myth. You can actually not do that. And by the way, he's one of my. I have two AIs. He's one of my AIs. That's what he thinks about heat maps. But first question, and this is very important to get us in the right mindset. First question, from a mathematical point of view, what is a risk? Like, how would you describe risk just in a single word that kind of explains the mathematical, the scientific
Deviation from mean?
Deviation from mean is basically volatility. Okay, so that's one option. What else? What other options?
Probability of something happening and having an impact.
So it's a product of probability and impact. Okay, that's an option. What else?
On quant level, you have the VAR value. What is the value? VAR.
Yeah. So VAR is a specific measure of risk. It's kind of similar to what you said. Now, so it's interesting that both of you said risk is a specific measure, but what if we look broader on the risk? Because VAR is derived from something. What is VAR derived from? What is risk actually? Because VAR is basically just a metric we use for simplicity to represent risk and to communicate risk and to sometimes aggregate risk.
The distribution.
Exactly.
Sorry, no.
But what did you say?
For me, a risk is the distribution, and we use a cumulative distribution of samples to define the continuous aspect of an event, a possible event.
Thank you. Long explanation for basically the same thing that you said, so thank you. Basically, risk is a distribution. Distribution means it's a range from nothing serious to catastrophic. Risk is always, in mathematical sense, risk is always a distribution. It's always a range. And sometimes we choose to simplify this range for communication purposes as a VAR. VAR is basically 95th percentile from that range. Yeah. So risk is a range. This is what it typically looks like. And VAR is just 1 point that we take for, again, the only purpose of it is just to simplify communication. Just because we choose VAR doesn't mean the other part doesn't exist. It's a full distribution. So that's the first point that is really important to understand. volatility risk, it's always a range. So it's not a single thing. Like risk is not a 5 or a 7. Risk is from 0 to 15 or from 0 to infinity, depending on what the risk is. It's always a range. So now we come to kind of to the second fundamental change, and something that, for example, challenges the whole concept of cyber risk, for example. So risk is a distribution, which is basically a distribution of a potential loss where, if nothing happens to something horrible happens, something catastrophic. And that's one way of representing risk, is we're basically saying this risk is significant because it could cost us, X amount of money at certain probability. But what else can we describe, or how else can we communicate what risk is by also using the distribution? But it's not a distribution of losses for a risk. What's the other way? And if you've read any of the Nassim Taled's books, he calls it f of x, because this is pretty fundamental stuff. It's absolutely critical to understand. What do you think is the f of x? What do you think is kind of the other way of representing? Not quite. In a different direction. Think in a different direction. So risk is a distribution of a loss from that risk. But what could it also be? If we're not thinking about a risk as a centerpiece, how else can we communicate uncertainty or volatility? So, for example, we produce rare earth. They are a commodity. The prices are set by Chinese. We have 15 elements. Each element has a separate price, and the prices are pretty volatile. So we can represent our market risk, our price risk, as a distribution of the potential volatility of the deviation of that price from something. But how else can we represent it? Any ideas? Any thoughts on what f of x could mean? Yes, please.
Maybe looking at that as an opportunity, and part of the opportunity is also the impact of that risk or of this distribution.
I think you're kind of close. Opportunity on let's kind of expand on that. And again, I'm forcing you to think laterally, because this is pretty fundamental stuff. This is changing the whole risk world forever. One way is to think about risk and the losses from the risk, and the other way, which Taleb calls f of x, is to look at the effect the risk has on something else, on a cash flow, or time, or schedule, or project budget, or anything else. And this is pretty fundamental stuff. When you represent the risk, not saying that we expect the VAR, the losses from this risk is 10 million. We can actually communicate exactly the same risk by saying this risk, together with maybe some other risks, could affect our cash flow by X. So the distribution becomes not the distribution of losses, but the distribution of effect on something, or on cash flow, for example. Project management is the easiest one, because in project management, I think this is now pretty standard practice. It's kind of surprising how it's not standard practice in everything else, but in project management, you've probably heard about cost and schedule risk analysis, right? They have a schedule which says we're going to finish this job in 6 months. And then each of the specific tasks, they are uncertain. And so when you combine all these uncertainties, what you actually get is you get a distribution of the time. And it says 6 months is actually the average expected finishing time. But there is a probability that we'll finish in 9 months. And there's a very small probability that we're going to finish in 12 months. Ask a question.
Now there is a nice book about it. Just the gold art. It's basically a consultant about. And he's exactly describing this. That there is probability in the project management, and it's really good to apply to everything, not just project management.
Yes. So thank you for reinforcing my point. I don't make up this stuff. I just tell you what other smart people wrote about.
What about this concept of if we don't take risks, we
Yes.
actually don't perform?
Okay.
Taking risk
Is a given.
lead to performance, lead
Yeah.
to better better return.
Yeah.
So this concept of like, yeah, because we always see risk as a loss, but risk is also gain.
Yeah. So this is a very good question, because this is not a critique. I'm trying to explain the concept. This question comes from Risk Management 1 world, where when you're dealing with risk registers and heat maps, that's an issue that you're describing. You need to somehow think about this. When you're dealing in Risk Management 2 world, because your assumptions are volatilities, are distributions, all of your assumptions are both, you go the upside and the downside. So you include in your risk analysis and your decision making, you include the full distribution, which by default includes the positive scenarios and the negative scenarios. So in my world, when I simulate uncertainty, to me it's a given that I actually report, I basically have the full cash flow distribution, where I have the cash flow distribution will actually, do you think the cash flow distribution will look like this? So answering your question, in my world, it's kind of natural to talk about both upside and downside scenarios, because everything we do kind of leads us to the full picture. All right, so the kind of the fundamental idea I want to communicate is A, risk is a distribution, and B, most of the time, despite what we today believe, most of the time we actually get much more value from not estimating the losses from a particular risk, but rather from estimating the effect risk has on something meaningful. And that's the difference between the kind of the Risk Management 1 mentality and Risk Management 2 mentality. In Risk Management 1, your centerpiece is risk, and you deal with risks, you mitigate risks, you identify risks, you assess risks, you have to kind of your product, your deliverable is something risk mitigation, risk register, list of risks, risk distribution. That's the world which I think is dying out, because in Risk Management 2 world, we communicate in, risks have an effect on schedules, times, budgets, and from that we can calculate contingencies and all sorts of things. So in my world, risks are always communicated as effect on something meaningful. And it kind of starts, so my risk analysis always starts with understanding, well, what is meaningful for us today. And it could be a budget, if I'm integrating risk analysis into the annual budgeting cycle. It could be a project budget or a project schedule. It could be a contingency calculation. It could be a cash flow calculation. It could be a new project valuation. It could be an NPV. It could be an IRR. So we always start with what's meaningful. What's the decision point? What's the decision criteria? Are we going to make this? Are we going to accept this project if it has a positive NPV? And then you kind of, okay, well, this is my starting point. And so now let me illustrate to you a case study using the same methodology, techniques that I literally used 2 days ago in the office. Imagine a business. It produces airplane engines, and it hasn't been doing too well financially in the past, but they've just developed a new type of engine, and they feel they're going to sell it to the market, both as a replacement for old engines and for new planes that are coming on market, and they're going to make more money on maintenance of both the old and new engines. So pretty simple setup. The management have done the calculation, and the business plan looks amazing. The only problem is that when they presented it to the shareholders started questioning some of the assumptions, and they realized that quite a few of the assumptions are completely unrealistic. And so they don't believe in the management forecast. They don't believe in management base case. So they asked the risk manager to stress test the business plan, to tell them what are the chances that this is actually true, and what are the chances of positive performance if we do incorporate risk into the analysis. Which is literally a question my CEO asks me all the time for different types of projects. What are the chances that this is going to be as positive as the management believes it will be, given the uncertainties that we have? And to understand the project, we really kind of do the same things that corporate finance due diligence does. We look at financials, and we're trying to kind of unwrap the financials, trying to understand. Okay, so profit 14, almost 15 billion. Sounds pretty amazing, right? This is the base case. 15 billion, whatever currency, profit, unbelievable. I mean, I wish I was working for business like that. Profitability 31%, right? Amazing. Unheard of in airline industry, but never mind. Cash flow statement, ending cash almost 30 billion. Amazing stuff. And is it still showing? Okay, great. And just looking at some of the performance indicators, they had some targets on revenue growth, profitability, and it's all above the kind of the threshold. So on the surface, this business plan looks amazing. And what the risk manager typically does, he starts to unravel whatever that decision at hand is. And the decision is, should the board approve the business plan, the new business plan, or not? That's the decision. But it could have been the decision, should we approve the project budget? Should we approve the project timeline? Should we approve our company budget? It's you basically, you start with the end and you kind of unravel it to understand, okay, well, what's sitting behind that? Because what's the first step in doing any kind of quantitative risk analysis? Okay, what does that word mean?
You need to have the figure and the assumption in the end for this start quantifying anything.
Well, in the moment, I think we'll get to that, but that's not really the first step. What's the first step? So we have the profit and loss cash flow statement. That's the end result. It looks really positive. What's the first thing that we do, or we should be doing in any risk analysis ever?
Understand the variables.
Exactly. Identify the assumptions. And you know why this is important? Because CIA has a tool called assumptions check. It's a fundamental. It's basically, whenever you do any kind of quantitative risk analysis, it's a fundamental first step. Check, identify what the assumptions are, find them, check them, and then comes your point of, okay, now we need data to understand how volatile, how uncertain these assumptions are. Some assumptions have very low volatility. Some assumptions have external volatility because it's market-driven prices or something, or foreign exchange, or oil or electricity prices. Some assumptions are internal. Some assumptions are based on some sort of tests that the management has done. Let's find the assumptions. And most of the time, corporate finance guys are pretty accommodating because they can actually put all the assumptions on a list, which is called assumptions. So yeah, thanks for that. Sometimes it's a mess. And as part of the understanding of assumptions, finding assumptions, what we actually discover is that some of the models used for decision making are actually horrible because they have a lot of calculation mistakes, they have missing assumptions, they have multiple assumptions, assumptions are spread all over the model. So in quantitative risk analysis, there is some level of corporate finance due diligence required. Doesn't mean you have to do it personally, but it helps if somebody in your team kind of understands how corporate finance works and can unravel a basic Excel model. Most Excel models are pretty simple because they tell a story. Like they explain how the logic, how the production and the financial and the administrative part of the business, how it all kind of comes together into the cash flow statement. And the two other things I forgot to say in the beginning, but let me reinforce that because it's very important. I'm showing this in Excel because if we can do it in Excel, we can do it in any other software. Like this is, I'm going to like the most basic level of automation, and the logic would work in literally any ERP system you can think of. And the second point I wanted to say is think of the examples I'm going to share next as kind of electricity. Again, not my idea. Sam Savage, a good friend of mine, came up with that. Think of it as electricity. Most of the people have no idea how the electricity is generated, but you have no problem using it, right? And benefiting from electricity. Well, this is exactly what quantitative risk analysis is. Most of you probably will never be able to do it, but it doesn't mean there is not somebody who can do it and just give you the results. And I think this is the revolution that I will talk about. How Sam Savage now created a risk language which allows me to create a distribution and send it to you via email. I mean, literally maybe even like WhatsApp. I can send you like a piece of text in WhatsApp that you can then use in Excel or any other software to turn your business plan or your budget into a risk budget. So there's a language that allows us to communicate, and Excel kind of evolved as well. So the Excel now understands that language, which is amazing because 10 years ago it couldn't. And now we really have kind of no reason to not convert any business plan or any budget into a risk model. So assumptions, macro assumptions, exchange rates, inflations, local, international. It's an airline engine, so they use a lot of raw materials, titanium being probably the most expensive one, so it's kind of pulled out as a separate assumption. Titanium price, as you can probably guess, is probably going to have a significant effect. And there are some assumptions on the demand, the overall market for new engines, old engines. So here are kind of the big global assumptions. And then we have the calculation and the operational assumptions, which every model tells a story. And I don't really expect you to kind of to fully grasp the model behind me on the screen, but I'll just quickly talk through the logic. Basically, the engine manufacturer makes money from two places: of selling engines and maintenance. And how many engines it can sell depends on the new planes on the market and replacement of old engines in existing planes. So that's basically what this thing says. It says sales DV30 is the old engine, sales of the old engine, and they expect this year to replace 12 engines in existing planes. That's what this says. And then sales of DV40, which is the new engines, and they expect to sell nothing this year. 2024, nothing. And then next year they expect to sell 20. It's pretty simple logic so far. And so then they have some maintenance. There is an assumption on how frequent maintenance needs to be compared to new engines. It doesn't really matter for our illustration. Just basically understand that there is a separate income stream from maintenance. And then prices for engines are set. We expect that the old engines, which we still sell, will cost 150 million. And the new engines will cost, in the market, 200 million. So that our revenue is a product of the amount of engines we sell versus with the price, right? It's pretty basic stuff. And then our costs are raw materials and personnel actually building the engines. Again, this is very simplified for illustration purposes because we don't really need to talk about it. It's not a workshop on corporate finance. So our cost structure is buying metal and then converting the metal, and there's all other costs, electricity and so on, and water and so on. Administrative costs expect 85 million, and we expect some sort of growth indexation of salaries and rent and all the other stuff. And we do have a loan. We think we need to borrow another 5 billion to modernize the plant, to build this new engine. So we need 5 billion to build a new engine. And we have some depreciation of equipment, and here's the uncertainty. We think we will need 5 billion to modernize the plant and build a new engine, right? So this is it. Like, this is the whole story. We sell engines, we get money from repairs, we have administrative costs, and we need to invest some capex into the plant to modernize it to allow us to build new engines. Yeah, that's the whole story, and it looks very positive because the end result at the moment is almost 15 billion profit. Yeah, amazing business. Simple and amazing business. What's wrong with that type of model and that type of thinking in general in business? And this is another learning point, which is absolutely fundamental. It's like it's changing everything forever. What's the problem with business plans and budgets in business?
In theory,
Things change.
Yes.
The world changes.
There's only one scenario.
Yes.
It's just one. Each decision is just one point of the curve of distribution of the probability of that
Yes.
that assumption.
Yeah. Does everybody kind of grasp the significance of this? Every single decision in business is based on a single version of the future. And it's a version of the future. It's a forecast. Yeah, there's a lot of assumptions in every business plan on the planet. Every decision, every budget is based on a lot of assumptions. And this is what I call the difference between the trader mentality and the risk manager mentality. The trader mentality chooses the future and believes in that future and then makes the decisions based on his belief about that future. The risk manager knows the future is uncertain and thinks it's really silly to make choices about future based on a single scenario because future is uncertain by definition. And what's the one word we can use to describe this model at the moment, this business plan? It's a nice word. I was more looking for a scientific.
Optimistic or
No, you don't know.
This is an excellent point, because here we know it's optimistic because the shareholders already told us go back and double check your assumptions because we do not believe you. We think it's too optimistic. But in reality, most of the time we actually don't know whether it's optimistic or pessimistic. I once had a sovereign fund in Middle East where they've actually done the calculation, and what they found is that they were not taking enough risk, and they could double the risk taking and therefore significantly get more money in returns because they were not taking enough risk. And that's the thing. Like, risk calculation your conclusion could be that you're not taking enough risk and you should take more risk because your appetite allows you to. And okay, but what's the word for a business plan that represents only a single scenario? What's the scientific statistical word for it?
Not very scientific.
Yeah. I mean, all of the answers are correct, but the word I'm looking for is deterministic. Deterministic means we set our expectations and assumptions, and that's what it's going to be. What's the opposite of deterministic?
Random.
Stochastic, which is basically exactly what you said. It's saying, okay, well, we have so many assumptions in the business plan. Most of them are actually very volatile. So it's the purpose of risk management then becomes what? What's the ultimate goal of a risk manager?
Decision making at the end.
That's the purpose of the decision makers, to make better decisions. But what's the ultimate goal of a risk manager? Given that existing business plans are deterministic.
to understand the risks, it has to create this distribution.
Okay, let's correct answer, but let's rephrase that.
Range of possibility or range of result.
Okay,
Results.
so try and paraphrase what you said, because it's again the correct answer, but we need something that will be crystal clear for everybody.
maybe support a change from deterministic to stochastic.
Okay, yes, and sorry. Yes, as well. So the objective of the risk manager becomes turning deterministic models into stochastic and therefore highlighting the effect uncertainty has on the decision. And what usually happens, and this is really surprising. Usually, what happens when you do that, the decision actually changes quite dramatically, because one of the fundamental problems in current business and management theories and corporate finance theories, they are designed to ignore uncertainty. There's a fundamental, like the whole purpose of business schools, what they teach you. If you open a textbook on management, on corporate finance, if you get certified in ACCA, CPA, CFA, they all teach you how to think deterministically. And there's this kind of never-ending game of coming up with the best possible scenario, which I think is quite ironic, because the opposite of that is just check for the full distribution and then base your decision on the uncertainty rather than try and pick the perfect future. So the objective of risk manager is to convert the decision model, whatever that decision model is, into something that accounts for uncertainty, for probability, for volatility. All right. So what I've done is I've actually pulled out all the assumptions from the calculation sheet into a separate sheet, and here are all of them. The inflations, currencies, prices, sales volumes, administrative costs, loan amount, and interest rates, and so on. So I've basically just pulled it out into a separate, risk dashboard. And these are our initial metrics. It looks pretty good, right? So everything's positive. All the profitabilities are above targets, and we have 50 billion revenue, ending cash 30 billion. I mean, what an amazing business. And then the next thing that you would typically do is, okay, well, at the moment the currency rate says it's 75, and we expect to sell 12 old engines and 20 new engines. These are the assumptions. What would be the next step? What would the risk manager do?
Define the boundaries for each one.
He would try and convert each of these assumptions into distributions, either based on external data for all the macro assumptions. For example, titanium price is something that you would simulate from historical volatility. Or if there is a forward curve, if it's a tradable commodity, then the investment banks basically tell you what they think the range of the titanium price is going to be in the future. For some of the more business-oriented assumptions, like for example, we're going to sell. They at the moment they're saying we're going to sell 20 new engines in 2 years' time. How would you convert that into a distribution? We've never sold the engines. We haven't even developed them yet. We still need to modernize the plant.
Yeah, worst case, best case. 20 is probably the best assumption. The worst case would be 0, probably.
Yeah.
And the best case is probably more than 20. I don't know, 30 for instance.
Yeah.
And you decide how is the probability to have more 0 than 30, which defines the curve you will use to circumvent the distribution.
So you would talk to somebody, a group of experts. You would triangulate, because risk managers never believe a single person. It's the rule that I just can't get across to one of my junior risk managers, is you don't trust what people tell you, because they never tell you the truth. And you triangulate. He doesn't get what triangulating means. It means you ask one person, and then you ask another person independently, and then you verify, and then you try to find some data to actually verify what the two people said, because probably both of them are lying. And by the way, most of the time people are not lying when you ask them about different assumptions. They genuinely believe in what they're saying. They just there's the whole 2 Nobel Prizes in behavioral economics, which teach us that when you ask somebody, especially if you ask them just before lunch, they're basically going to give you a completely misleading answer. The point I'm trying to make here, because this is such a common question, like how do you get the range? Let me just reinforce this point. When we are comparing a deterministic model to a stochastic model, if you literally did plus minus 10% and you used a, what's that distribution which is equal? Uniform. Literally, if you used plus minus 15% and used a uniform distribution, it would be better than a deterministic model. Like anything is better than a deterministic model. Let me kind of get across that point, because everybody's like, oh, how do we get a distribution? If you did no investigation and you just replaced all the assumptions with a uniform distribution with some kindergarten parameters, it would be a better decision than if you didn't do it. But in reality, of course, talking to people, we have a lot of data from production. We have business plans, due diligences. We have external providers that kind of give us sufficient data. I mean, I've never used a uniform distribution in my life because I really never had to, because there's always enough data. And there's a special distribution for expert opinions. Like if you ask 3 people and they give you their estimates, you can convert that into a distribution. What's the distribution? What's the distribution specifically designed for expert opinions? Which one? PERT or triangular, but PERT. And sometimes, like in project management, for example, somebody already decided which distribution to use, and they just use triangular everywhere, which I think is a horrible thing. But they, nevertheless, it's like there is significantly more than we think there is. In terms of guiding us on how to do it. Like we don't really need to make up stuff. It's all been done before. And for example, inflation is log normal. Prices are usually log normal. Like there are actually the first David Vos wrote a book called Quantitative Risk Analysis. He literally has 100 distributions and he explains which one is used when. Like, for example, for equipment breakdown, there's a special distribution that we use. So, like, we don't have to make up stuff. All of this is done. Like, this is old stuff. This has been done for so many years that we just repeat. We don't really need to struggle with that. Like, that's the least of our problems, finding the right distribution. And if you have some data points, you can always fit a distribution to your data points. And there's another friend of mine, Tom Killen, who came up with metalog distribution, which basically allows you to fit to almost any continuous data. So, like, I think the future of risk management is that we're not going to even care about different distributions. We're just going to use one because it's universal. It's going to be metalog for everything. But you don't need to worry about that for now. And then, of course, the other thing is give me any assumption. I don't know if it's going to work, but let's try. Give me any, like, have a look at this, and which assumption do you want to find out the distribution for?
Raw material.
Which one?
Raw material.
Raw material. Okay. We want to estimate the cost of raw materials for the engine manufacturing. Which distribution do you think we need to ask? I don't know if it's going to answer because, actually, yeah, it is. Okay, blah, blah, blah. Log normal, it suggests. Right, skew. So it's actually not ideal. And he's saying you can also use a triangular if you have clear understanding of the minimum. But it gives you a starting point. I would have used a different distribution. I need to teach my AI better to think more like me. But the point is that 5 seconds, right? Typed, got an answer. That answer is good enough for you to already make a huge difference to the decision, to the initial decision, because remember, the initial decision was deterministic. All right.
Would you do practically so with titanium price?
Yes.
And also do some risk management on thing, and then tell you, look, which is that something on natural gas, where
there was always suddenly this huge peak.
Yeah.
And then he said something like, well, I'm not an expert at this, but
Yeah.
all the titanium comes from XYZ.
Yes.
If the Chinese take over that titanium,
Yeah.
came over, how do you take this into this assumption?
So titanium is probably a commodity that is tradable. So you'll get historical data from that, and that's a good enough starting point. What is a very important message that I'm trying to get across? If you just took historical distribution and you would look at it, and it's actually, you actually don't take the distribution of titanium, you take the distribution of the returns, like the daily returns on titanium, and what you would discover is that the returns are actually probably log normal, just like for most of the other commodities. And that's good enough to use in the model, because some of the other assumptions are going to be expert, and you're probably going to use 90th percentile or 80th percentile as your conclusion. So your model is initially designed to be pretty high level, and for the high level model, that's already good enough. And then if you wanted to adjust it and incorporate some other, spikes like the highly unlikely but catastrophic events, you would include it into the historical data set, and then you will get a different parameters for the distribution. That being said, I highly doubt you would ever want to do that, because again, you're moving from deterministic, which is ignoring all risk, to stochastic, which shows you some risk. And let me again reinforce this. If you literally, so we have 20 assumptions here. If you just added volatility to one assumption, that's already a huge progress compared to what you had before. So you don't have to go from nothing to the most amazing model on the planet. And most of the time you make business decisions based on like P90 or P50, which by design excludes catastrophic events. So you write a caveat saying, this conclusion is based on 90% of scenarios that we've investigated, and there's at least 10% scenarios which are much worse, which we don't know because our model is not designed to deal with them. And what you would do in this case is you would actually flag this risk as a separate item, saying, okay, but there is a highly unlikely chance of a catastrophic event, and what do we do with that risk specifically? Do we hedge against it? Do we find a different supplier, or do we design based on different materials? Each assumption can actually be represented by a range, and sometimes we use log normal, sometimes we use PERT, sometimes we use triangular, just for illustration purposes. And what I want to do is I want to quickly switch to a stochastic version, because normally you wouldn't have like a static and stochastic. I just use it for illustration purposes. Let's see what happens after we added the volatility to the model. Remember our results: amazing cash flow, lots of money. We're doing really well.
Just one comment.
Yes.
When moving from static to stochastic, the complexity of this exercise goes up exponentially.
Which exercise? What do you mean? Try to paraphrase the point.
Moved from point estimate of each best case scenario
Yeah.
to a stochastic representation of the problem with multiple parameters for each distribution.
Yes.
And each parameter has its own range, right? So when you think about normal, you enter some values that are static, but in reality they are also probably stochastic. So I've changed every single assumption to a distribution. Yeah.
And Excel, so I've just done it live. I've just literally converted the model from a deterministic into a stochastic model. And Excel didn't freeze up. It took me a few seconds to do it. So what I'm saying is the technology now, because there's this language of communicating uncertainty and risk, the Excel can now handle it. And ERP system does it in obviously much quicker than Excel. So let's have a look. Let's have a look at what the reality looks like now. we still have some revenue growth, but we are making losses. We're not profitable, and all our targets are below, and we actually are both cash flow negative. We have negative EBITDA. So it looks like once we've added volatility to each of these assumptions, the business plan went from, oh my God, this is amazing, to this is a horrible business idea. Don't do it.
I'm surprised that you don't come back. You don't end up with a range of results, and
You
not
do.
with a fixed.
Yes, that's a very good point. Because, of course, you end up with the range of the results. The whole purpose of converting deterministic into stochastic is you come up with a range of cash flow, range of revenue. What I've chosen is to show you the metric, just for, because they had the previous metric as a single number, and now I show them the updated number using the same metric. It's a very important point that you raise, because in risk management 2 world, we communicate effective risks using the same language that the business uses for decision making. So if they use NPV, I would give them back risk analysis as an effect on NPV. And I would give them like the new expected NPV and then the worst case NPV. Or if they, for example, if they're asking for profitability, then I would give them the average profitability, the pessimistic scenario profitability, which is P90, and then optimistic profitability, which is P.
So you come back with a range. You will.
You always have a range.
range.
And in fact, so I've just uncovered the rest of the screen. So this is EBITDA over the years, and this is what the risk does. It turns it into a range. And then we have these little tables where, again, I just pulled out numbers, key metrics, P10, P90, basically from P10 to P90, that's the range. Yeah, and P10, P90 just means percentile, 10th percentile out of the 100 in the distribution, and then 90th percentile. So for EBITDA, the higher the EBITDA, the better. So the 90th percentile is the positive scenario, and the less EBITDA, the worse. So P10 is the pessimistic scenario. And I've given some other parameters. And here's here's the ending cash flow as a loss curve. Basically, there's the green are the positive scenarios, and you can see based on the volatilities that we've included, there is some upside. It's just ridiculously low. And that's not. And by the way, this is not a joke. I once did a business plan for a government private equity fund, sovereign fund, and we needed to take a 5-year business plan to the Ministry of Finance for the approval. The probability of positive cash flow in the business plan after we've done our risk analysis was 0.000003%. So when I presented that to the management, I said, well, we probably don't want to take that business plan to the Ministry of Finance. And so they ended up changing assumptions, changing project priorities, reshuffling portfolio. And the final business plan that we took and defended at the Ministry of Finance had 70% upside scenarios, 30% downside scenarios, which I thought was extremely brave because nobody in the history of country ever took negative scenarios to the Ministry of Finance in the past. It was quite amazing that they actually took a business plan which had a 30% chance of failure. And they said, we are innovative private equity fund, and you have to accept that there is risk. It's not a risk-free investment fund, which I thought was quite brave. All right, ending cash flow, this graph, I've highlighted, there is this little chance of positive cash flow, everything else is negative cash flow.
Isolate.
Sorry.
Isolate. What is the trigger that came from a very positive first statistic or
Yes.
static
Yes, no, I understand your question. Yes, of course.
The one who actually now we show very bad, like very lost results. So
Yeah.
I don't know, maybe it's one or two things that we need to
Yeah. Normally we just do a tornado diagram, and I'm not going to do it now because it's time consuming. But yes, of course, your first conclusion, basically coming back to the management saying we've done the stress test, it's all negative, it's really bad. You need to rethink the business plan, and here is why. And then kind of the next question is, okay, here are the assumptions that are so uncertain that they really push this business plan into the negative. And then you start working on, okay, what can we do? Can we hedge? Is there maybe nothing we can do? That it's also a scenario where you've done the risk analysis, and here's another story on how we've actually changed the legislation for solar generation, which I thought was also quite exciting. Literally the following day after the risk analysis paper that I've done, I saw in the news that the CEO spoke to the Deputy Minister for Energy, trying to lobby the change in the legislation. We were doing the risk analysis for the solar panel generating company, and what we showed, basically, the business was going to go bankrupt in 3 weeks. And under different risk mitigation measures, it would go bankrupt in 3 months instead of 3 weeks. And there's nothing management could do to save the business. But because it was a strategic industry, what we basically discovered is that the prices were for energy generated from sun was set in the legislation. There was a fixed price, but the costs increased, and the price formula did not reflect the cost volatility. So when the interest rates went up, the foreign exchange changed. The cost of producing became higher than the price that they were allowed to set by government in every scenario plausible. Like 100% scenarios, bankrupt. And so they changed the legislation to adjust the price formula to reflect the business is still surviving. All right, but the final point I wanted to show here is that this becomes a very critical area. It's called contingency. It's basically you do the calculation, you understand how much is at risk, and you also understand how much extra cash the shareholders should reserve or have available to deal with unforeseen scenarios. And we now include contingencies in everything. Like we have contingencies for CapEx forecasts, we have contingencies for sales, we have contingencies for OpEx. We include contingencies for every significant line item in the business plan, basically saying, okay, we think this is going to cost us 10, but we better include 110 in the budget because based on our risk analysis, we actually see that the expected cost is going to be higher. All right, so yes.
Contingencies changed by the industry?
Contingency is a product of your risk analysis. So contingencies change from day to day. Like if you've updated your risk analysis, you've got a new contingency. We've just calculated the contingency here. It's 23 billion, which kind of gives you an indication that no way this business is going to survive because nobody's going to reserve 23 billion for a contingency.
Can you just elaborate in a few minutes on the numbers and how you get from one value to distribution to that result? Can you just comment on the number and how you get to the
Sure. So basically,
so here, what are already these numbers?
So at the moment, this in the calculation, we have this is the foreign exchange. It gets pulled over from the assumptions tab. At the moment, it says 91 because I've changed it from static to stochastic, from deterministic to stochastic. Here, what it says, if the switch is on stochastic, what it does, it replaces 75 with a distribution that has these parameters. And the language or the standard that I'm using is called SIPMath standard. Is basically a way to communicate to Excel that this cell is no longer a single number. This cell contains the full distribution, and then it in the background runs through 1,000 to 10,000 simulations, and then it shows me when I look at the results here, it actually gives me the full distribution inside the cell.
So the number is average, and from that distribution, correct? And then you're making a number of random iteration.
Yeah, and except I don't have to do any of that because it just does automatically. Basically,
yeah, but just to understand the mechanic.
Yes, the mechanic is that you tell the Excel that this cell is no longer a single value. It represents the full distribution based on the parameters that you tell it to think. And then what it does is when you then start adding and multiplying different distributions together, it Monte Carlo simulates it, because you can't add distributions together. You have to simulate how they will combine, and it gives you the result in the form of a distribution. And you can interrogate this, and you can say, okay, what are the chances that ending cash flow is going to be positive? So what are the chances that it's going to be above zero? What are the chances it will be similar to the base case, which was 29 billion? What are the chances it will be below, above? What's the average expected cash flow? What's the pessimistic cash flow? What's the optimistic cash flow? Basically, this cell now contains the full distribution, and you can interrogate and ask questions about this cell to make all sorts of conclusions.
Sigma is determined by your historical data, or
The what, sorry?
the sigma is determined.
It's up to you. You can use, if you have historical data, you can use historical data. If you use expert opinions, you can use expert opinions. All right. So that's basically what I wanted to share, is that every business plan or model we now use in the company is stochastic, or when it's not possible because the model is just too huge to turn it into a stochastic model, we use P30 or P40 as a risk-adjusted base case. So we don't use an average base case. We use kind of a more pessimistic base case because we feel that uncertainty is too great. Questions? Yes?
If you have dependencies like correlation, then the example you assume that you get your plant done,
Yes.
you get so many engines produced for that you can sell so many engines.
Yeah.
The correlation or covariance that is
Yes.
there. Can you bring it in?
Yeah, of course. So again, the first point is you're moving from deterministic to stochastic. So even if you did not include correlations, you would already be in a much better place than before. Because what correlation does, it either makes the effect greater or lesser, but it's not so dramatic that we would completely change the decision. And if you really wanted to, then of course you include correlation. If you have significant evidence to suggest correlation is stable, and then you would include it into the model, which there's like a function for doing that. The one interesting thing that I did is I always check correlation for stability, and what it turns out is that if you take its historical volatility over the last 10 years, correlation changes all the time. So basically, sometimes it's positive, sometimes it's negative, and at the end of the day, you just decide, okay, we have to put a caveat that we are excluding correlation because it's not stable. And this is another fundamental difference between risk management 1 and risk management 2. In risk management 2, you know your limitations and you are very transparent about the limitations. So you would say, this data came from interviews. We approximated it using a Perth distribution. We've excluded correlation because we couldn't find enough evidence to suggest that it's stable enough. We modeled some assumptions, and we chose to exclude other assumptions from the calculation because we didn't have enough data or we didn't have enough time. All of this kind of goes into the appendix of risk analysis. Now, tell me, how often have you seen a heat map with a page of covenants saying, yes, but it's also subjective, yes, and you shouldn't believe that and use that for decision making, and there's actually a lot of research to suggest that it's mathematically flawed to be used for anything? Have you ever seen somebody being honest about the limitations of the methodology? Well, with risk management 2, with quantitative risk analysis, it's a given, because you put a lot of caveats on risk analysis, because we do make active methodology decisions, and many of the decisions are shortcuts because we know that moving from nothing to something, even a little bit of volatility is already. It takes us to a better place. All right. Any other questions?
So actually, you showed that we are using some distributions which are parametric. Do you ever use non-parametric models for such analysis?
That's insurance talk. I don't understand that. What's a parametric distribution?
So you are using actually log normal, like standard sum distributions.
Yeah.
But they are
as opposed to?
Yeah, but there are like non-parametric models which you doesn't define them as distribution as like log normal or normal or something like that.
Yeah.
So you just run a lot of like simulations to gather information from historical data and to have your non-parametric model, your own life distribution. Have you
Okay, I think what you're saying.
Yeah, and if it is had like any additional positive like impact on your models and analysis.
So I think what you're saying is that you can use your data fit historical distribution versus a forecasted distribution where you're trying to represent the data with some sort of relationship, and you can do both. Basically, Excel at the moment can process I think like 15 different distributions, and one of them is metalog. Metalog means you can take your historical data and you can fit a distribution exactly to your historical data, which, by the way, is not such a good idea most of the time because unless you had a very representative case, like for example for insurance, I cannot do that. We use statistics for the body of the distribution, and we try and fit distribution to the actual losses. But for the tail of the distribution, because not many catastrophic events happened, we can't really use statistical data. We have to estimate using the same GPD distribution that insurance companies are using. But both. Excel can process both, and you decide which one you want to use. Just for fun, and because I'm a nerd, I have this, which is probability distributions 2, different distributions for the same assumptions, and I can switch between stochastic 1 and stochastic 2 just to see if I ever wanted how will the result change if I change my assumptions about distributions, and it doesn't most of the time. So it's more fancy play for the risk managers. Like we sometimes I used to have PhD in mathematics, and they get very excited and they're like, oh, we need to fit the best distribution. Nobody cares. Yes.
From your experience, do insurance company welcome this approach? Because then you talk their language, you can discuss assumptions.
So here's an honest reality. When we were buying insurance in Europe, we saved $13 million by using this logic and showing them all of this, like all of our loss exceedance curves. We basically we calculate the loss curve for the insurance policy, estimate how much it should cost, and we tell them how much we think they should cost. Saved us $13 million. Huge positive impact. I don't think they welcome it. Most of them don't even understand what we're doing. The brokers are completely ignorant to what we're doing. And but nevertheless, the result is we've made a lot of money. I'm now doing exactly the same in Brazil. Does not work. The underwriters are so mature and the brokers are so mature, they cannot even comprehend. That's my hypothesis. I don't know. But so far, I had zero positive result in Brazil because they just they ignore pretty much. I tell them exactly the same. Like, this is what the fair price is. They look at it, they don't get it, they ignore it completely, and still charge me 3 times what they should be charging me.
It's a more tariff market, Brazil, so they're confounded to these old tariffs they have right away. And it's very difficult for them to.
Like for some, it's only relevant for some insurances, but I always try it on the insurances where there's no predefined tariff. Although you are right in the sense that the head office from Europe usually sets pretty specific guidelines for the rates. And so even if they want it, they can't really do much. But also, it's there's a big component of complete ignorance and low maturity to understand that. But the management loves it. And every single time we talk about new projects, new business plans, the question is, how does volatility affect our assumptions? What will the numbers look like if we added volatility back into the conversation? Hernan.
Yeah, just from here, the key decision you presented is a 5 billion investment.
Hmm?
The plans both the same for 30 years,
Yep.
right? So all agree for budgeting or long-term planning, it all makes sense, but at the end of the day, you take a decision which comes longer, and you use relatively aggressively pass-through assumptions on macros, because they're basically saying, if interest rates go up, if steel prices go up, all these kind of things, and
Yeah.
you cannot hedge 30 years out, so
Yeah.
at one point in time it operates down to
That-
the price elasticity of your demand.
That's a very good point, because if we look at an NPV model, it's usually like a 30-year NPV model. What we do is we follow exactly the same logic as business. And what business does, it forecasts next 5 years and then it just extrapolates. And we do exactly the same. We forecast and model risks in the next 5 years and then we just extrapolate. This is a very, very important point. In risk management too, we do exactly what business does. We literally open their files, challenge their assumptions, use the same data sources as they use the same format as they use, make conclusions for the metrics that are important to them, to the business, to the decision maker. Risk management too. So risk management in my world is changing the decision parameters, how they would have made the decision with if I wasn't there. So all I'm doing is I'm literally giving them exactly the same metrics, just showing the volatility around that. And giving him like if they're saying, okay, we need IRR, I'll give them a risk-adjusted IRR. If they want NPV, I'll give them a risk-adjusted NPV or a distribution of an NPV. In my world, risk management is mirroring everything the business is doing. I'm literally, I don't think you fully grasp the significance of this, because at risk and model risk existed forever. Crystal ball existed forever. The challenge with this product is that you model, it's much fancier to model in, but then you need the software to actually look at the results. And sometimes you can put the metrics into different cells, but in general, to interpret the results, you need to have the software. What this does, this new language of communicating risk does, it adds volatility to the original file, and the management can continue working in the original file. And then they can, for example, the CFO opens this up and he goes, I do not believe that the average should be 12%. It will be 25%. For 5 seconds. I've just resimulated 10,000 scenarios, and I have a whole new set of results. In the original Excel file that the business plan was done in, I literally take the files and I add all my risks and volatilities into their model. And this is like the next thing is, this can be opened on the phone in Excel, and you can change stuff on the phone, and you can resimulate on the phone. Like, this is mind-blowing stuff.
Just to be clear, that's chance code now, or is it?
So
in Excel by standard now.
You create it in ChanceCalc. To create it, you need a free add-on. Well, there is a free and a paid version, and then it turns into a normal Excel file, which has no additional functionality, no additional software needed to be installed. Just a typical Excel, and not only it opens on any computer, which is kind of a given, it resimulates from a phone. Obviously, none of you care. It just blew my mind, because that's. Can you think about that? You send a model to the CFO, he can open it on his phone, and he goes I don't agree with this assumption. He changes it and it just resimulates 10,000 scenarios instantaneously on the phone. He goes I don't believe this assumption. I want to challenge the assumption. Fine, please do it. I call these models calculators, because they're designed, basically, I create the infrastructure for the management to change the assumptions, and then they can go in and make whatever assumptions they want. We think we're going to sell 30 maximum. So 1, 2, 3, 4, 5. 5 seconds. All right. Sorry. I apologize. It was unacceptable of me. No. It's I'm also playing up on the joke. So just resimulate it, and it's a normal Excel, which is kind of amazing.
So, but why do you, is then kind of like when you're saying the teams are still doing the work first, and then you check afterwards if the management wants.
Yeah.
Why do you not turn then and implement it from the beginning? That even
I think
at least all major projects should have to do it
Yeah.
from the beginning.
I think you get it. Like, I think you now get it. That's the whole idea. Is that sometimes we're trying to catch up, and you catch up when you do kind of this, risk stress testing initially to get your foot in the door, and you get enough credibility for them to allow. Like, people are pretty sensitive about their models, and some models are not as clean as this model. Some models are impossible to simulate in because they're just a mess, and there's a lot of error. Like, for example, here we haven't talked about this, but this is pretty exciting stuff. Here, they did a little trick. They said our price growth is going to increase every year with inflation, which is a really stupid assumption. But and then not only with inflation, so historical growth was 4%, and then suddenly they made it 12%. So they've hidden a little bomb inside the model to trick the results. Like, that's actually one of the reasons why the results were so positive. They basically just lied about the growth potential for the engine price. And we identified that when we were doing the initial checking and due diligence on the model. And we've actually changed the assumption that when we turn stochastic, we actually not only simulate the inflation, but we also reduce the effect of the inflation on the price by 3 to bring it back to the original growth rate. So we've actually made a change to the formula. And the end game is to obviously work with each of the business units from the very beginning, create templates for them, and kind of give them the competency to build stochastic models from the very beginning. But to do that, you first need to kind of have enough respect and attention. And it always starts with, let me calculate the contingency, let me stress test your business plan. And then going forward, it's like, okay, we need to start building stochastic models from the very beginning. What's the point of building a base case and then stress testing it? I'm not there yet. Like, I'm already calculating all the contingencies. I'm already doing stress tests on the business plans, and I'm in the stage where instead of P50, they would use P30. Like, if I know what the volatility is, I know what the assumption distribution is, they're not going to use the average like they would have before. They would use like a risk-adjusted average. It's a whole thing. You can actually calculate from a sample. You can actually calculate the confidence interval on the average, and you take the lower bound of the confidence interval of the average. But it's unnecessary information.
Just a remark for your intervention. One of the biggest difficulty for me, because I put a lot of efforts to implement this type of methodology on project management for 5 years now. The biggest difficulty is to let the project manager accept the idea of being trained on a new way of seeing the volatility of their project. They don't want it at all. They don't want to face the reality of the uncertainty of their project and potentially to be refused by the management. So the difficulty for me wasn't to elaborate all these things. It was really to convince people to use it. And it's not as easy as it seems. It's for me the biggest difficulty.
That's a good point. I mean, the calculation part is easy. Convincing everybody to use it and to allow the risk manager to challenge the assumptions, it's a cultural thing. And at the moment, I'm really lucky because the CEO expects volatility on all of the assumptions, all of the decisions. Okay, but here, let me show you kind of the funky thing. This is another chatbot that I've trained, and here's what the future looks like. Give me a downloadable file with 5,000 trials of a PERT distribution with mean 10, mode 30, max 50. So you don't need a PhD in mathematics now to generate distributions.
But it's 13 seconds.
There you go.
So it's worse and worse.
So it's actually really nice because it's quicker than if I would have done it manually in any of my software that I use for generating distributions, because I would need to click on a few buttons and then I would need to type in the same thing. So anyway, here's the.
I don't know if it's true or not, but my kids have told me that if you say, please give me, the results are much better.
And faster.
I don't know. But I don't know if that's true or not. Yes? Really?
Treat it with respect and say that.
Okay.
Yeah.
So there you have it.
So by the way, this is not foolproof. Oh no, it worked. So well done. But AI makes mistakes. The reality is it makes less mistakes that my human PhD risk quants used to make. So what I'm trying to say is you have to double check everything. But it's not. It's 10 times faster and pretty much similar amount of mistakes. So it's pretty scary. So there you go. We have 5,000 distributions, and because this language of communicating risks, I can now go to this cell and I can actually pull that 5,000 into this cell and say tell Excel that this cell now contains 5,000 iterations with the parameters that I've said, and it just became a stochastic model. So I had AI generate me the distribution, and then I can use the SIPMath standard 3 to pull it into any Excel file on the planet, and the file just became, if you refer to that cell from now on, all the calculations are going to be stochastic. They're going to actually iterate 5,000 times. So you have 5,000 cash flows, 5,000 revenues, 5,000 EBITDAs, and so on.
Can you add a seed when you launch the distribution and you request the distribution? The random distribution. Can you? Does it fix the seed, or you can choose it?
So this is a very important question, because we needed seeds because in the past, because every time we would resimulate, it would resimulate a new thing. What the standard does is that it simulates once, and then it just keeps it in Excel, and it's the same 5,000 trials forever, which means it's auditable. Which means if an auditor opens this model in 3 years' time, they can see exactly what distributions you used, and you can see each of the trials. It's pretty kind of mind-blowing stuff. So you don't even need to worry about the seed. The only reason you needed to worry about the seed is because you wanted to replicate your results. You wanted some sort of consistency in modeling. Now you just do it once and you keep it.
Being deterministic is stochastic, but
yes, exactly. The whole purpose of this language is you generate the distributions up front, and then you add them to Excel, and then Excel becomes stochastic with these distributions stored inside the model.
Right.
Any other questions?
Well, I still think we lack good practice in the expert opinion estimates, because actually that's the easy part what we just did.
Yeah.
How to get the 3 points.
Yes.
I think the risk management.
Yeah. So
I think that's actually the worst.
A hugely important point. And remember what I said in the beginning is just because I don't talk about something doesn't mean it doesn't exist. You have to calibrate the experts. You have to challenge, triangulate. You have to try and compare to the actual historical data, because the big problem with 3-point estimates is they're bounded, which means if you said this is the maximum, it will never model anything beyond your maximum. And if you said this is the minimum, it will never model it beyond your minimum. This is actually horrible because humans are not really good at estimating. And if you say something is not going to cost us more than 300, then your whole model is built on this assumption that it's never going to be more than 300. That's, for example, why unbounded distributions like log normal are probably better, because they still leave you that highly unlikely but catastrophic scenario. Basically, 3-point estimates don't have any catastrophic scenarios by design. They literally cut it out. And people are not particularly good when they're tested on wide the ranges. People are so bad that they usually give a very narrow range, much narrower than they should have. Over optimistic bias, and it's a whole separate exercise to calibrate them and get to the level where the estimates are truthful. But again, remember, that's maybe 5 steps in the future that you need to worry about that, because at the moment you're moving from deterministic to stochastic, and if you literally did plus minus 15%, you would already be in a much better place than you did before. And by the way, I never do plus minus 15%. By the way, in project management, sorry, I'll let you ask the question. In project management, what association gives you the ranges? Because they've done a lot of empirical testing, and they literally tell if it's a highly conceptual, poorly developed project design, what's the range? What association is giving you specific ranges? Does anybody know?
-10 plus 100%.
So they literally tell you, like, for project category 5, it's like -50 plus 100. Who does that? Because there's like a whole international organization that literally gives you these estimates, because they've done a lot of testing too. So you don't even have to make this up. You just borrow their methodology and then you quote their methodology. They have 3 standards on specifically monte-carloing, modeling uncertainty for projects. I haven't told you yet. I'm hoping that somebody knows, because like this is pretty fundamental knowledge. It's for cyber. So by the way, this is like, again, FAIR is well, I think we're still friends. They spoke at Risk Awareness Week a few years back, and this was my big critique to FAIR, is that they give you the calculator, but they really should have spent, because they have so much data, they really should have spent time and actually giving you the estimates, because they can, and they just choose not to because it's too difficult and too liability. But there's an association called AACE, which is the American Association of Cost Engineers, that literally gives you the ranges for different types of projects. And there's another guy in UK, Brent Flyberg, who has done a lot of other empirical testing on smaller projects, on like bridges, roads, hospitals, Olympic Games, and he gives you like the expected multiplier. So he gives you that on average, if we think this project is gonna cost 100, historically these types of projects were 120 or 175, and you can convert that into distribution as well. So there's a lot of the data is the least of our problem. Selling and convincing people to use this is obviously the real challenge.